Credit derivatives are financial assets like forward contracts, swaps, and options, for which the price is driven by the credit risks of economic agents. A credit derivative is an OTC derivative designed to transfer credit risks from one party to another. Credit derivatives take many forms. Three basic structures include 1. Credit default swap, 2. Total return swap, and 3. Credit linked note. A credit default swap, or CDS, is a credit derivatives contract between two counterparties. The buyer makes periodic payment to the seller, and in return receives a payoff. If an underlying financial instrument defaults or experiences similar credit event, the credit default swap may refer to a specified loan or bond obligations of a different entity, usually a corporation or government. For example, the buyer makes regular premium payment to the seller. The premium amount constituting the spread charged by the seller to insure against the credit event. If the different entity defaults, the protection seller pays the buyer the par value of the bonds in exchange for physical delivery of the bond, although settlement may also be by cash or auctions. Total Return Swap, or TRS, is a financial contract that transfers both the credit risks and market risks of an underlying asset. Total Return Swap is a swap agreement in which one party makes payment based on a set rate, either fixed or variable, while the other party makes payments based on the return of an underlying asset, which includes both the income it generates and any capital gains. In total return swap, the underlying asset referred to as the reference asset is usually an equity index, loans, bonds, or baskets of assets. This is ordered by the party receiving the set rate payments. Total return swap allows the party receiving the total return to get exposure and benefit from a reference asset without actually having to own it. These swaps are popular with hedge funds because they get the benefit of a large exposure with a minimal cash outlay. Let us assume that Bank A owns an asset that periodically gives interest rate payments. Assume that Bank A, the protection buyer, and Bank B, the protection seller, have entered a total return swap contract. According to this contract, Bank A is paying all the interest payment on the reference assets plus any capital gains over the payment period to Bank B. Furthermore, Bank B is paying LIBOR plus a spread as well as any negative price change on the assets. In case of a default on the underlying assets, the asset is valued to zero, and Bank B has to pay the full interest market price of the assets. Credit-linked notes is a note much like a bond in that it has regular payments that are usually paid on a semi-annual basis. However, a note can be customized. A credit-linked note, also known as a CLN, is a note with a credit default swap extensions. The issuing company sells the credit default swap to the bank and receives an annual fee, which it then passes on the investor of the note in the form of higher return. The credit default swap also allows the creditor or bank to transfer the risk of defaults on the note back to the companies if the companies cannot pay its investor. So, the credit-linked note structure provides banks with insurance against default risks, and companies or insurers with ability to pay investors a high rate of return. For example, Bank A lend money to a company XYZ, and at the time of loan issue, credit-linked note bought by the investor, the interest rate on the note is determined by the credit risk of the company XYZ. The fund the bank raises by issuing note to investors are invested in bonds with low probability of default. If company XYZ is solvent, the bank is obligated to pay the note in full. If company XYZ goes bankrupt, the investor becomes the creditor of the company and receives the company XYZ loan. The bank in turn gets compensated by the return on less risky bond investment funded by issuing credit-linked note.